Let's talk about the equities market. So in this lesson, I'm going to introduce you to the stock market, or also referenced as the equities market. And this one's interesting, so obviously we're talking about Forex, equities, cryptocurrency mainly. This Forex market is pretty straightforward. It's pretty simple. You're mainly looking at roughly 28 currency pairs and so on that you're analyzing on a daily basis. Cryptocurrency market is still developing, still new, and still growing. It's only about a decade at this point, roughly. Well, it launched in 2009 with Bitcoin. So it's still pretty fresh and pretty new, and it's still finding its way. The equities market has been around for a very long time, decades, And the thing that's really interesting about the equities market is that you can trade it full time and go really deep into it as well if you want, but you can also just be pretty passive with it and pretty part-time if you wish as well. Just kind of sit on the sidelines and only watch a few different tickers and so on, or companies. So the thing that I want to talk about a little bit is, obviously in this lesson, I'm going to introduce you to stock trading, equities trading. I'm going to jump on the charts in a little bit and show you some of the characteristics of the stock market and things that you need to be aware of. But in the description below, there's a guide. We put together a guide to stock trading, so read that over. All the information that you require is literally in that guide. It's very, very comprehensive. So a lot of the topics, a lot of the terms that I'm going to be referencing within MasterClass here, within these next few lessons, they're already inside that guide. So have a read through it, make sure you understand it. If there's any part of it that you don't understand, again, go on the internet, go into your search engine and just research it a little bit more. But again, guys, very comprehensive. Check it out in the description. But what I'm going to do here is, again, go from kind of like a trader point of view, chart analysis point of view, things that you really need to understand, some things that you need to understand, the characteristics of the stock market. And in the next few lessons, I'll show you how to create your watch lists, 2 different ways. So with that said, as I started off talking about this introduction, when it comes to the stock market, there's many different things that you can focus on. You can focus on various sectors within that stock market. You can focus on various industries within that stock market. So sectors and industries, they're totally different things. You can also focus on the US equities market, Canadian equities market, Australian, Japanese, German, right? You can focus on any type of equity market all around the world. Every single major country pretty much has an equities market associated to it, right? And one of the major characteristics of these markets is that the equities market in general, let's talk North America because that's the one I'll focus on, is that it's only open during the New York session, right? So where the currency market is open 24 hours a day, 5 days a week, right? It's closed over the weekend. The cryptocurrency market is open 24 hours a day, 7 days a week, and never closes, right? The stock market is only open during the working day, in the specific region where it's located. So in North America, it's just the New York session. It opens up in the morning, closes in the afternoon. Australia, same thing. It's open during the Asian session, right? In Europe, it's open during the European session, during that work day, right? And then it closes. So it's a little bit slower. The price action develops a little bit slower throughout the day and throughout the weeks than it would with the Forex market or the cryptocurrency market, because those markets are open 24 hours a day. So with that said, that's kind of it for now. I'm going to jump on the charts and talk a little bit more and show you what the price action actually looks like. So let's have a look. So the one major characteristic that you need to be aware of when you're trading the equities market is you need to understand the majority of the time it is bullish. It is really hard to short the equities market because, as we're all going to see on the charts in a second, is that majority of the time it goes up, right? And there are small corrections throughout that time, but majority of the time it goes up. So when we look at the chart here, on the top left, I have the monthly chart of the S&P 500 index. So this is the S&P 500 index. It holds the top 500 companies in the US. And you can see this index goes back all the way to 1970, so quite a few decades. And by the look of this chart, you right away see that all the way from 1970, I mean, we've been making new higher lows pretty much every single decade, right? It just goes up with corrections, okay? So what are these corrections? Every single one of these big kind of pullbacks is typically associated to some sort of a recession, right? So here we have the 1973 crisis, big drop in the equities market, okay? Then right there, 1981, pretty decent correction. Right here, 1987, another major correction in the equities markets. 1990s, 1991 roughly, minor kind of drop. And then here we have the big one, the big correction of 2000, 2001, which was the tech bubble. And then we move on to 2008, which was also a pretty severe global recession, right? And since then, we've been in this big bullish run pretty much this entire time with a few small pullbacks, right? So again, as you look at this chart all the way from 1970 to present moment, we're mainly in a bullish market, right? So if you, from an investment point of view, obviously if you're investing using dollar cost averaging or whatnot, investing at regular intervals, right, majority of the time it's just going to continue going up and up and up and up, with certain recessions that cause global market corrections or just market corrections in general. The majority of the time it goes up. So from a trading point of view, whether it's day trading or swing trading, you also have to keep that into consideration. The majority of the time the stock market goes up. So when we look at the daily chart here as an example, right, so that was the monthly chart dating all the way back to 1970s. And if we look at the daily time frame and we zoom out on this daily chart, again, we'll notice that majority of the time it goes up, but hey, you know, there are little pullbacks all the time, but check it out, it just continues to go up and up and up and up. And now that's obviously the S&P 500, which are some of the best companies in the United States of America. Well, some of the largest companies, they're not always the best, but the largest. And here was this was 2008 recession, right? So obviously it fell pretty heavily to the downside. But since then, you can check it out, since the recession, again, the general state of the S&P 500 was bullish, right? With some heavy kind of little volatile corrections. And you can see these corrections don't last a long time. They just literally drop for about a week or 2 week period, consolidate, and then the new trend begins, right? So that's something to keep at the back of your mind. And I mean, if we go back to even the last previous recession of 2001, when it bottomed out here in 2002, since then till 2008, again, it's been in this bullish market with small corrections, small little pullbacks, right? So the way to trade this, right, is again, understand that the best opportunities will be to the upside, right? Whereas within the Forex market, I mean, we're trading with the trend. So the trend is either bullish or is bearish, right? Here, the trend is mainly bullish. And every 7 to 10 years or so, it changes to, it becomes a bearish trend during a recession, right? A recession, when looking at the monthly time frame, a recession typically happens every 7 to 10 year period, right? So since 1974, right here, that was the bottom of the 1973 recession. So 1974, the next major one was 1982, right? Just over 7 years. So 1982, next major one was 1987, 5 years or so, right? Then we have a little one here in 1990. That was kind of minor, but again, a little one. And then since 1990, it took a decade for the next correction of 2001, right? And then since 2001, it was 2008, roughly 7 years later, that was the next correction of 2008. And now, at this point, since 2008, it bottomed out in January pretty much of 2009, it's been a decade since that last correction. So just looking at this monthly time frame right away, you'll notice that again, these markets, the US equities market in general, I mean, the other markets, global markets will differ a little bit, but the US equities market in general is bullish for anywhere between 5, 7 to 10 years, right? And then during those roughly between 5, 7, 10 years, within those cycles, at the end of those cycles, there's going to be a correction. There's some kind of a correction. There's a pullback, recession or whatnot. Let's just call it a market correction. And those typically last about a year or so, maybe 2 years max, but typically roughly a year. So we're bullish for about 7 years on average. Correction typically lasts a year or so on average, right? So that's again something to remember. And that's kind of it, So from a trading point of view, when we again look at this daily time frame, it's simple, it's just understand that the market is generally bullish, right? So from a trading point of view, it does follow trends really well, where it has pullbacks and then it continues, and it has a pullback and it continues, and so on, right? And with that, you can again trade the trend. So every single time there's a pullback, you can get into it and ride the next wave until the next pullback, right? And some of these runs are pretty big. Like if you check out this run since 2017, it started in August 2017, concluded here in January of 2018, right? Pretty big bullish run. And then obviously we had a little correction here, which was pretty heavy, of 2018 October to the lows right there of December 2018. It only lasted a few months, and then again, now we're in another bullish wave. So that's kind of it from understanding how to approach the equities market. Mainly the one thing that I want to point out here is shorting the equities market is pretty difficult at times, right? Just because those corrections, they're just little pullbacks. Majority of the time, they are literally just little pullbacks. And once in a while, when volatility really picks up, specifically near the end of these cycles, 5, 7, 10, right? We get massive volatility, and that's when a bigger correction happens. But typically, it's just mainly little pullbacks within a large bullish trend. So again, any long opportunities, you can potentially hold them for a few days, weeks, months, right? Any short opportunities at this point in time, majority of the time, okay, unless we're within a correction, but majority of the time, the short opportunities will be short-lived, right? So maybe only quick in and out positions, that last a few days, maybe a week, maybe a couple weeks at max, because soon, once that pullback happens, the new run will begin, because the world is very optimistic when it comes to their companies and the equity markets in general. It's typically very, very, very optimistic, and fear typically comes in roughly once a decade during a correction, somewhere between 5, 7, or 10 years, right? So majority of the time, it is very, very optimistic. Hence why whenever there's a correction, a little pullback, right away it sparks new growth in the industry. And then once in a while, fear comes in, and that's when a correction, a bigger correction or recession happens. So from an equities market, know that you can trade the various ETFs, right? ETFs are some of the major indexes, such as SPY is just an ETF that, again, you can trade the S&P 500. So you can trade the top 500 companies, some of the largest 500 companies in the US. You can trade them using ETFs, exchange traded funds. Now within those ETFs, you also have companies, right? Such as Microsoft, Apple, Google, Facebook, Morgan Stanley, and so on, right? Some of the major companies, and every single company is typically within some sort of an ETF. So an ETF is typically an index that is holding companies within a certain sector, or it's an S&P 500 index, or it's a sector index, or it's an industry index as well, such as aerospace. Aerospace would be an industry. Energy would be a sector, right? Financials would be a sector. Large cap stocks is mainly an index that holds all the large cap companies such as the S&P 500 or SPY. So you can trade these ETFs and they're pretty simple to trade, right? They're very liquid, they're not volatile, but there's a lot of liquidity within them. They're pretty heavily traded, right? So the ETFs are a very easy way to trade them, to trade the equities market. But within those ETFs, you also have companies that you can trade, individual companies. So if you want to invest in Apple or Facebook or any other stock that you're interested in any aerospace, because you're keeping track of space travel and so on. So you're keeping doing research on any type of aerospace companies, so you can again trade individual companies as well. So that's how the stock market really differs. You can trade individual companies. You can trade ETFs, which are kind of larger indexes that hold a bunch of companies within them. Either it's sector ETF or an industry and ETF and so on. You can also invest in global equities, frontier markets, emerging markets, and so on. So it's very diverse, right? And that's kind of what I really like about it, is that it's very diverse. And if you're interested in a specific industry, right? If you're very interested in technology or clean energy or cloud computing or artificial intelligence or blockchain or the financial markets in general, you can go and do research within that specific sector and industry, and then create yourself a list of stocks or ETFs that you follow and trade on a regular basis. So that's kind of it. That's a brief introduction to into the equities sector. And in the next lessons, I'm going to walk you through how to actually create your watch list, right? So how to create your kind of watch list that you scan on a regular basis, either every single week or every single day. And then how you can also this is going to be a two-part watch list creation. First part is, again, making kind of like a watch list that's a standalone that you will be checking on a regular basis. And then a secondary kind of watch list which changes from day to day, right? Which is more of an active watch list based on what is actually happening in the equities market. So that is it for this introduction. Again, equities market to me is really interesting, as you can dive really deep into it if you want, but you can also be pretty passive and part-time with it by just focusing on various ETFs and so on and not really conduct much research within it. So you can be pretty passive or you can be very active within it as well, which is something that I really enjoy. So that is it for this introduction to stock trading. Some of the major characteristics were outlined, and again, check out the guide below for a very comprehensive, detailed explanation of the various parts of the equities market, and I'll see you in the next lesson. Take care.